The 30-year Treasury yield, the ultimate alarm bell for fear, instability, systematic risk, just surged past 5%.
Welcome back to Power Lunch and take a look at yields. The yield on the 20-year bond is higher now at about a couple-year high, 5.11 after the 1 p.m. auction that pushed yields up on the long end across the board, really.
That's one of the highest levels we've seen since 2007. The trigger? Another devastating blow to America's credit rating. But this story isn't just about rising yields. It's about a crumbling foundation beneath the global financial system. Because when trust in US debt starts to fracture, everything tied to it, your savings, your mortgage, your dollar, it all starts to fracture with it. This isn't business as usual. This could spark what could be something even far more dangerous. A full-blown financial reset that strikes right at the heart of your financial security. So why are Treasury yields exploding? How long can the US pretend that everything is under control? And most importantly, how can you prepare before it all unravels? Let's break it down. America's last AAA rating is gone. Moody's, one of the three major credit rating agencies, just stripped the US of its final perfect AAA rating. Let that sink in. That's been held since 1919, okay? They held it all the way through the Great Depression, 2 World Wars, not even through the Nixon shock of 1971 did they actually downgrade it. And that blew up the gold standard and redefined global finances. Nope, Moody said you guys still get a AAA rating. Through everything over the last 100+ years, Moody's has been like, we're good, until now. Why? Because the US debt is out of control. Because political chaos is paralyzing any path to a real solution, and because the trust is evaporating and the world knows it. This isn't just symbolic, it's a clear message to the global markets. US debt is no longer as risk-free as it used to be, and once that illusion shatters, everything is going to change and change fast. If you've been tuned into the financial and economic markets, this move might not be a surprise. But I think most people are grossly underestimating the significance of this. A nation's credit rating works just like yours. When it drops, borrowing costs spike. Only this time, it isn't just some maxed out credit card. It's the US government. And we're sitting on nearly $37 trillion in debt. We're already burning over $1 trillion a year just to pay the interest payment. So when our yields are going up, our payments on the interest are going up. This is where Treasury yields explode into the picture. Treasuries are how the US funds its spending. But when fewer buyers are showing up, which is what's happening, yields rise. That's to try to lure them in. In simple terms, the government has to pay more to borrow. That pain, well, it trickles down to you and me, and fast. When the world believes the US is stable, well, then the yields will be low. When they believe that it's going to crumble, well, yields will rocket upwards. And right now, that rocket is on the launch pad. What's different this time? Well, for decades, the US got away with reckless borrowing because the dollar was the world's reserve currency, and as long as the world needed dollars, well, they needed treasuries. Well, guess what? That buffer is vanishing. Nations are stepping away from the dollar. They're diversifying into other currencies. BRIC nations are trading with each other, and they're all watching America's debt swell, well, to monstrous levels. We've entered into a vicious cycle, and frankly, I don't see a way out. Borrow more to pay the interest, then borrow even more to cover that. The system is eating itself alive, and the downgrade from Moody's didn't create that problem, it just confirmed it. And while this may sound super dangerous, the cycle doesn't even account for the nuclear option, which is we print even more money just to pay the bills. The experts are already sounding the alarm. Ray Dalio, one of the most respected minds in macroeconomics, he's warning everybody, the worst is yet to come. He's not guessing, he's reading the data, and he's not alone. Central banks worldwide are repositioning themselves now. And they have been for years. They're seeing the writing on the wall. They're seeing the signs. And guess what? They're front running. They're taking action now as the fallout is accelerating. Why? Because credit ratings like Moody's only look at the risk of outright default. But that's not the most likely outcome. No, the real threat is inflation-driven debt destruction. Governments printing trillions to meet obligations while gutting the value of our currency in the process. This isn't just a problem for investors. This is a threat to every single American holding dollars. Dalio said it straight. If you care about your wealth, you should be far more concerned than these ratings suggest. Even Treasury insiders have quietly admitted that these downgrades are a lagging indicator. Translation, the damage is already done, and what's coming next could be catastrophic. This crisis has been in the making for decades, and let's be honest, this didn't start last year. This isn't one side of the aisle's fault or the other. This is the result of decades of overspending, short-term thinking, and political dysfunction, and now, well folks, the bill is coming due. Calling this a lagging indicator isn't calming. It's not here to make anybody feel better. It's confirmation that we're already deep in the red zone and the clock is still ticking. So I'll ask you directly, do you really think the US can climb out of this debt spiral? Or are we headed for a controlled demolition of our current system? Let me know what you think. I really want to hear from you. Drop something in the comments. Because if Moody is finally pulling the plug after more than 100 years, you better believe they see what's coming. And even if they don't say it out loud, we should. The flight from the dollar has already begun. As confidence in treasuries evaporates, countries are dumping dollars and moving into hard assets, like gold. In the last 4 years, central banks have been buying gold. They've been buying a ton of it. In Q1, they've already bought 244 tons of it. That's 25% more than they have been over the last 5 years. Why? Because gold doesn't come with counterparty risk. You can't print it, you can't fake it, and you can't devalue it with a printing press. Gold has always been the ultimate safe haven, and now it's replacing treasuries in sovereign vaults across the globe. Now here's how it affects you. Rising treasury yields means rising costs on everything. Mortgages, car loans, credit cards, your day-to-day life just got more expensive. Meanwhile, your paycheck has been staying the same. Your savings are shrinking in real terms. Your future debt becomes an even heavier burden. And if this continues, well, inflation will be the least of our concerns. This could be the opening chapter of a hyperinflation event where the dollar loses value faster than people can react. That's when the government's going to step in and reset the system. And rarely when they do this is it in our favor. This is why gold matters more than ever. Throughout history, fiat currencies have collapsed, and every single time they have, gold stood firm. Because gold isn't a promise. It's not based in confidence. It's real money, the kind that survives empires and resets. If you don't have a plan yet, well, wake up. Now is the time. Not when you see more headlines, but now. At Advantage Gold, we specialize in helping people create strategies that protect their wealth from inflation, currency devaluations, reset, political risk. Call the number on your screen or click the link in the description. It's time that you book a free consultation and learn how you can use physical gold and silver to protect your wealth before it's too late. You've worked too hard to build it. You'll sleep better knowing you've acted before the collapse, not after. My name is Jeremy Blossom with Advantage Gold. We're your trusted source for gold, silver, and long-term wealth protection. Thanks for watching and stay ready.